So, are you wanting to buy, needing to buy, or even thinking about buying a home in New Jersey? Then today, this is an important video. We're going to talk about something uber important, maybe the most important, wouldn't you say?
Definitely the most important.
And we're also probably going to hurt your feelings. So if you feel a little bit sensitive, you might want to hang on for this ride because we're going to hit you where it counts. That's in the wallet, and we're getting after it right after this. So if this is your first time to the Living in New Jersey channel, and even if it isn't, please feel free to click on the subscribe button and tap the bell for notifications so you can get alerted to amazing videos like this. Because, you know, they are pretty
They're
cool.
awesome.
They're awesome. Who are we kidding? Watch this video. You are watching it. We get emails on the daily. We get calls. We get texts. We don't deal in faxes. If you watch my videos, we know how we feel about the faxes. We don't do that. But the people that you see around me right here, you see those happy faces? That's what you want to be. You want to be a homeowner. Right now, you're a prospective home buyer, home shopper. That's why you're watching this video. In today's video, it's going to get crazy. And like I said, you know, if you're a little sensitive, we might hurt your feelings here, right? What we're talking about today is income. But before we get to that, my name is Matthew Williamson. I'm a luxury realtor here in New Jersey, but don't let the luxury spook you. We help everybody out there. You don't necessarily need to buy a $15 million lakefront property.
Wow, $15 million.
Yeah, it's a nice one. I was shooting for like a middle number there, but like a $15 million lakefront property, right? So we'll help anybody. You just reach out to us. And today, this fine gentleman right here to my left or your right, depending on how you're looking at it, he's going to introduce himself. Go ahead, boss.
Good afternoon, everybody. My name is Brian DeVito. I'm a Senior Vice President of Mortgage Lending with Guaranteed Rate.
Excellent. And you've been doing this how long?
Long time.
Long time, folks. If you've seen our videos, you know how long he's been doing it.
Long time.
Long time. And he's Senior Vice President. We need to put like a fancy banner up there. This guy knows what he's talking about when it comes to cash and money. But what we're talking about today, income. People are like, I'm not going to listen. I don't want to talk about income. Nope. Listen, we're going to hit you in the wallet. We're going to make it hurt. This is going to be a painful video, so just deal with it. So this is probably, and I think you would say,
It's the most important thing when looking to get a mortgage.
yeah, it really is, right? There's a lot of pieces to this. We know we get all the conversations, we get the questions, right? We know there's a lot to it, right? There's different layers that go into buying a house. But probably the most important is income, right? How you're paid, how long you've been on the job. There's a lot to that, right? And that's a sensitive subject. People don't want to talk about finances, right? People don't want to say how much money they make, how much money's in their bank account, all that. They don't want to talk about it. It's sensitive, right? You'd rather like give up your firstborn child. It's true. Than like talk about that stuff. People are like, I'm not gonna talk about how much I make. I make enough. You don't need to know how much I make. Yeah, we do. So today we're gonna kind of go down the line. We're gonna look at the different ways that you're paid and look at the ins and outs and kind of pros and cons of how that all unfolds. So, Mr. Money, where would you like to start?
We'll start off with the easiest. If somebody is a W-2 salaried borrower,
Salary.
calculating income's easy. We're going to take your annual salary. Let's say it's $100,000. Divide by 12. That's $8,333.33 per month. We've calculated your income. Done.
I'm gonna need a calculator for that. I'm just bad at math.
You want me to do $120,000, which is $10,000 a month? Make it a little easier for you?
No.
Okay.
But no, salary at the top. Easiest. Somebody's like, I want to buy a home. How are you paid? Salary. Boom. There's no time limit?
No, I have a loan in process right now for somebody that is getting relocated to New Jersey. They're not starting their new job until September. They're closing on a new home in July. They're not even going to be on the new job yet, but we're allowed to use their income because it's salaried. We've got the employment contract from the employer, and they're going to be on the job before their first mortgage payment is due.
So just so I know I heard you, because I think my ears are kind of perked up there. Someone is coming into Jersey from out of state. They have started the process and all of that before they even start on their job.
Correct. And they're already under contract on a home.
So you're basically saying they haven't got a check yet from the new place.
Nope.
But they were able to go into process.
Correct.
Woo! So salary with a bullet, easiest one to deal. In certain cases, kind of case by case, they could go through the process, try to buy a house before they even start the new salary job.
Correct.
Awesome. So if you're salaried, it's pretty clean, pretty clear cut, easy peasy, right? The information will be down below later when we get to the end. You can do a pre-approval and knock it all out. So let's move on to number 2. Which one is that, Brian?
Hourly.
Hourly pay.
So if somebody is hourly, but they work a set amount of hours per week, let's say 32 hours a week, we would take their hourly wage, multiply it times 32 hours a week, multiply it by 52 weeks, divide by 12, that would be that client's income. And the main thing that the bank's gonna look for is consistency. We want to see that that employer is guaranteeing them a certain amount of hours for work. And in that scenario, somebody could potentially be on the job for 6 months, but they work 32 hours every week. We could potentially use that income.
Oh, excellent. So once again, we know with hourly, and obviously we know there's full-time and there's part-time, right? We have a couple tiers to that. So if you're hourly, once again, you might say, hey, I'm full-time. Now, to be clear, full-time can still mean variable pay. So if someone says, hey, I'm full-time, but I'm not always consistent. It's not 32 hours, every week or whatnot. It's 32 or 38 or 36 or 40. Someone that has that scenario, but yet their average would be above 32 hours, is that problematic or is that okay?
No, it's going to be okay, but we're only going to be able to use that, that guaranteed hour, the guaranteed hours that they work. So if they're guaranteed 32, but they work 38, we're not going to be able to give them credit for those other 6 hours unless they've been on the job for 2 years.
Okay, so that with that whole variable, once again, 37, 38, this, that, and the other, it's like, great, you're making that money, but unless they've been on the job for 2 years, you're just going to give them the bare minimum full-time,
Correct.
32 hours. Okay, that makes complete sense. Hopefully you guys understood that and that you're with us. And if you've been there 2 years, now 2 years worth of paycheck stubs, then you can count the whole money.
2-year average.
The whole 2-year average. Okay, so what about part-time now? People might be like, hey, I'm part-time, I work, I have a part-time job.
So typically with part-time employment, the lender's going to want to see a 2-year history because with part-time, the hours fluctuate. So again, the lender's looking for consistency. So if somebody has a part-time job, as long as they've been there 2 years, we'll take a 2-year average of what they earned over the last 2 years, and we'll use that as income.
Now with part-time, is there a scenario where someone could potentially count that income and be on that part-time job less than 2 years?
Potentially. Let's say we have a client that was a stay-at-home mom and she's been out of the workforce, but now she's back. She's been on the job for 6 months, let's say. And let's say she works 15 hours every week. We may be able to potentially use that income, depending upon the type of loan that they're looking for. We may be able to use it without being on the job for 2 years. The key there, though, it's her main source of income. And she works a consistent 15 hours, based on that example.
So in that scenario, someone can't have multiple jobs. It's got to be that part-time job alone. That
Main
is the
source of
main
income
source of
now.
income. Okay. So really you can count income
Possibly.
as a part-time.
Case-by-case basis.
Yeah.
And as you mentioned, too, with part-time jobs, if somebody works 2 jobs, the lender needs to see that that client has a 2-year history of working 2 jobs in order to use that second job's income.
Wonderful. Okay, so we've covered salary, which is the easiest. We've kind of just gone through hourly and part-time and full-time and what that looks like. So what would be the next one down? We're talking about pay that is overtime, bonus, and commission stuff?
Sure.
So that could be like a car salesperson. Hey, you car salespeople out there. So that's a lot of, the car
Or
sales folks.
mortgage and real estate agents.
Oh,
too.
yeah, that is. So we're going to just call ourselves out. Yes, I guess. We'll include us in that. So for pay, that is bonus and overtime and commission. So just being silly, picking easy numbers because, he's math and I'm bad at it. But basically, you got $100,000 a year. That's your salary, $100,000. But looking at it, of the 100, half of it, let's say $50,000 is bonus or overtime pay.
Got
What
it.
does something look like? When can I use that?
Typically, the lender's going to want to see a 2-year history. And then again, because, bonus, commission, overtime, those income sources fluctuate. So the lender's going to want to see a 2-year history so we could, again, take that 2-year average. Now, again, as we mentioned before, there are some cases where we may be able to use any of those variable sources of income. Minimum, it's going to have to be at least 12 months. But less than 24. So again, depending upon the loan that you're looking for, the program you're going with, we may be able to use it with less than 2 years, but more than 1 year.
So based off the loan parameters, right? Based off of that, somewhere between 12 or 24.
Correct.
And that just depends on the type of loan that they
Correct.
with everything. Okay, so that's your overtime bonus commission. You guys with us? 12 months minimum, case-by-case basis, depends on the loan that you get. Otherwise, the other side of that coin is 2 years worth of history for bonus, overtime, and commission pay.
Yep.
Now, down at the bottom, and I hate to word it that way, but let's get to the people, and I think I'm one,
You are.
right? That it's the hardest, believe it or not, to buy a home. And that is self-employment. Self-employed. And Jersey is full of self-employed people, right? Businesses, construction, you got pizzerias.
Realtors.
It's me, all of us. There's a lot of self-employed people here. Now, with self-employed, obviously I'm one. There's some advantages to self-employed, right? And one of those is you write off what you need to write off in Jersey,
Your
right?
business expenses.
Yeah, your business expenses. You know, the people in Jersey are like, yeah, Matt, business expenses. You're just like, yeah, I own a construction company, ABC Construction, and Matt, I made $500,000. It's like, really? Yeah, we had a great year. And then they show you their
Schedule C, maybe on their tax return, and we look at line 31, and it only had $80,000 in income.
So they wrote off like $420,000,
Yeah.
you know, and that one of those was their work vehicle, the $100,000 Range Rover with a magnet on the side of it that says ABC Construction. And mind you, on the Range Rover, you got the top trim level. Good for you. And wrote it off. So I jokingly say that, yet it's really not a joke. If someone is like, hey, yeah, $500,000, and you're writing all of that off, it is devastating to you. It's devastating. There's another video of ours that'll be at the end credits of this one as well that's kind of called debt to income. We sort of touch on that more in depth on debt to income. But if you're like, I make all this money, and then you write it all down, what happens, Brian?
Yeah, I mean, so there's pros and cons. You know, somebody like Matthew that's a Schedule C employee, you know, you can write off your expenses so you pay less in tax. And, you know, we all hate taxes. But for somebody that is a Schedule C employee and they write off a lot of expenses, you know, that's going to potentially have an impact on the amount of money that you're going to be able to borrow from a bank.
When you are self-employed and you have the Schedule C, right, and you're filing all your own stuff, with that, and you're like, hey, I want to go buy a house, I want to start that process. Is there a standard time limit for that? Like how long do you have to be, you know? And I know there's different scenarios. So what if, you know, someone's full-time at job ABC, and I say full-time, let's even say they're salaried at job ABC, right? They got the salaries, you know, their checks coming every week or every 2 weeks, it's standard, all of that stuff, it's stable, and they switch jobs into all of a sudden a job that is now full-blown self-employment Schedule C.
2 years. So we're going to need to see a 2-year history, something with self-employed clients. And there's other forms aside from a Schedule C. You could have an 1120 tax return, a 1065, you know, depending upon how your business is set up and how you're paid. So it's not just Schedule C, but typically we need a 2-year history of being self-employed. Again, we're going to take a 2-year average and allow you to use that income to qualify. However, there are some loan programs available where if you're self-employed over 5 years, we may be able to do your loan with only 1 year's worth of tax returns.
So if I'm hearing that correctly, I think I'm hearing you correctly, is if you're at the salary job, is that what you're saying?
I'm saying if somebody's self-employed, and let's say they've been self-employed for 7 years, let's use you as an example. Let's say that you've been a realtor for 7 years. Let's say you wanted to buy a home. We may be able to use only 1 year's worth of your tax returns rather than having to take a 2-year average. And sometimes I've seen where, you know, I talk to a client, they're self-employed, they've been self-employed 7 years. I look at both tax returns. Sometimes the most recent year is double what the prior year was. Depending upon their loan program, we may be able to just basically use the higher year's worth of income and not have to incorporate the year before, which would then limit what their buying power is.
With all of that said, because that was well put, but if you're self-employed, there's a little bit to that. That onion's got a few layers.
Yeah.
And like what I was trying to say a second ago is what if that person out there is like, well, I just worked 5 years at ABC company. I was salaried at this job for 5 years, and now I just started this new job that's full-blown Schedule C, self-employment. So they can't count the previous jobs in.
Yeah, because they're not working there anymore. So, you know, we're only going to allow somebody to use income if they're still working there.
Which is great. That's great to know. So once they abandon ship or jump ship, it's 2 years.
Yep.
Now, is it ever less than that, depending on loan parameters?
Possibly, but again, I mean, there's a lot of the things that we covered today. There may be cases where, again, you know, we mentioned before, if somebody was maybe a stay-at-home mom, they got back into the workforce, they've been on the job for, 6 months, it's their main source of income. That may be an instance where we could potentially use that income not being on the job for 2 years. So, yes, I mean, a lot of these things, there may be case-by-case situations. It's best if you have questions just to reach out and we can see if we can use your income or not.
That was well put. So really what we did today is sort of just cover meat and potatoes, kind of give a simplified breakdown.
Yeah, income 101, we'll say.
Income 101. But, beyond that, if somebody has questions out there, obviously have them reach out to you. You're the math specialist. I am not. Is there anything else we want to touch on?
I think that's pretty much it.
Pretty much it. All right. Well, that is the breakdown of Income 101, as Brian said. All of our information will be down below. So if you want to reach out to me, reach out to him. We'll be more than happy to help you out. Once again, thank you guys for watching. We appreciate you tuning in, and we'll see you around the block.
Have an amazing day.
Take care.